Want to dig deeper now into this report with Joe Brusuelas. He is chief economist at RSM. Joe, good to have you on the show again. What is your reaction, just first off, to this jobs report this morning? Okay, Joe, I think you need to unmute yourself there. There you go.
It's good that we see all these workers being recalled to employment. 4.8 million is nothing to discount. I think, though, when you start to lift up the hood and you look at this report, and of course you compare it to what we're seeing in the near real-time jobless claims data, there's still plenty of concern out there. I think the big takeaway here is this does not give permission to those who do not want to extend unemployment insurance or aid to the 31.5 million people who remain on aid through the week of June 13th to discontinue that. We're going to need to see sustained policy aid forward to support the U.S. economy. Okay, inside the report, I think the thing we want to begin looking at is the median duration of unemployment, which was 13.6 weeks. That's jumped to 7.7 weeks. That gives really one a sense of where we're at in the economy. My sense here is that the near real-time data, not just the initial jobless claims, right, but restaurant reservations, mobility, job postings, all point to significant slowdown here in the third quarter. I expect going forward, we're going to see much slower pace of recall for workers. And if not, if things continue to get worse, especially with respect to the pandemic, we could see another period of losses. I still maintain we're going to see the unemployment rate go back up later this year. Last thing, this is all about testing, tracing, and treatment. Until we get a regime in place that's coordinated nationally, we're not going to see recovery to January 2020 economic levels. Any talk of recovery separated from that, don't trust what that person's saying.
So Joe, you see the unemployment rate going back up. Does that mean this summer we could see job losses instead of job gains with these monthly job reports?
That's right. What you're going to see here is the economy grinds to a halt again because of the pandemic. You're going to see people put out of work. Unfortunately, the PPP did work, right? And it make no sense, make no bones about it. But once the aid ends, you're going to see people who've been recalled to work probably let go. We're also following the temporary versus permanent data or permanent job loss data. I got to tell you, we saw an increase in June of permanent job losses. This is not what one wants to see when we're supposedly entering a period of recovery. I think that's going to be one of the real important issues here later this summer and into the early fall.
So Joe, having said all that, I'm looking at the market. Dow futures up 437 points right now. So when you look at the stock market, is this kind of rallying sustainable as we go through the rest of the year? And would you say that we are actually in a new bull market right now?
Okay, a couple things. Stock market decoupled from the real economy years ago. The economy is made up of small and medium-sized businesses. What you're looking at today is a sustained rally on the likelihood that we'll see some sort of therapeutics or treatments come to the fore later this year or in early 2021. In a bull market, I'm not so certain I'm comfortable with stating that we're in a bull market. I like the fact that the Dow and the S&P are full of companies that are in technology, media, telecommunications, life sciences. Those are firms that really are COVID-19 impervious. They're going to do well regardless of what happens. And of course, as we see other companies begin to be integrated into these indexes, like DocuSign replaced United Airlines last month, this makes sense to me, and you'll continue to see those equity levels remain very strong. But I'm going to put something forward. If we do not see what I call an inclusive recovery, where the rising tide really does lift all boats, you're going to see social tensions rise around these equity values, because it will begin to be seen that there's an economy that's separate and distinct for the wealthy and well-connected. And there's another economy for those who make about $50,000 a year, and the twain shall never meet. It's really important here that as we move forward, we see a broad and inclusive recovery. If not, with a new administration perhaps in the offing, you could see very different rules and regulations around the market that will not be conducive to rising equity prices.
Joe, great to have you here. Jared Blickery, I just want to follow up. That was a really interesting comment you just made on the social aspect. You said before you don't think we're in a new bull market. How do we get there? What does it look like? And is it simply out of the question right now? Because as you said, with rising equity prices, it just increases social tensions.
Is that directed at me or someone else?
Yeah, that was directed at you, please.
Well, look, the number of firms publicly listed has shrank dramatically over the last 20 years. These indexes simply do not reflect the changing structure of the U.S. economy or the changing structure of U.S. society. My sense here is that equity markets are the companies that are listed publicly, that make up the S&P 500, that make up the Dow, need to step up their social outreach, whether we're talking about ESG or we're talking about some of the very things we've seen in June with respect to the civil unrest in the country. Those companies need to understand that they need to pay a wage so that the people who work for them and the people who use their products, right, can live at a reasonable rate. We need to focus on the fact that this is going to take a long time to dig out. The unemployment rate is going to be unreasonably high for a long period of time. I'm very happy that we see a near 11% unemployment rate. That's a good thing. We want to see that drive. But we also want to look at that underemployment rate, which was above 18%. I mean, when I take a look at the jobless claims data, that 31.5 million that are on some form of unemployment aid, remember, before the pandemic, we had a 158 million person workforce. You just start to do a little bit of division and you get a sense of where the country's at. That's not where the equity markets are at, not even close.
All right, we're going to leave it there. Joe Brusuelas, Chief Economist at RSM. Always a pleasure, and have a good holiday weekend.
You too.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.